Hey everyone, Eric Dutram here with the latest and actually the final edition of the Dutram Report, the podcast on ETFs and more. That's right, today's Dutecast will be my last for Zacks, as I'm actually moving on to a different company at the end of the week. Now, this is a bittersweet moment since I'm excited for the new position, but I've definitely enjoyed working at Zacks the past 6 years and hopefully increasing everyone's knowledge about the ETF market as well. However, I didn't want to leave you hanging and ghost any loyal listeners out there. That's why I wanted to take a long-term look for today's podcast and, investigate some funds which could have some staying power over the years. In other words, what are the 5 ETFs I like for the next 5 years and why? Arguably, the why is even more important than the funds, as you might agree with some of the trends, but feel that another ETF or two could play it better from your perspective. Or who knows? With the rate of new ETFs hitting the market these days, it's certainly possible that a more targeted fund or two launches in the very near future. But at least for right now, these are my favorites for the group. So the idea was to come up with the number of funds which you could theoretically buy today and leave in the portfolio untouched. A sort of set it and forget it list of funds where I think the long-term trends are very supportive for growth and hopefully profits over the long haul too. But I didn't want to just look at one or two market areas. I wanted to give you a broad cross-section of the global equity market with a variety of picks. I also wanted to give a nice mix of tried and true, well-known ETFs, as well as a couple that might have flown under your radar, but don't worry, they're sufficiently popular as well. So listen on for my selections, and feel free to tweet me at Eric Dutram if you agree or even if you disagree with any of these picks. But besides that, let's get started. So the first area I want to look at is tech, and how could you really pass up a tech fund in today's market after all, we're in such a tech-heavy world these days, and the market is really demanding growth, and this is one of the few areas that can offer it up to investors in spades, and I think it's definitely going to continue for the long haul as well. Now, one area in particular in the tech world that I like is the Internet of Things. And as anyone at Zacks can tell you, I really love the Amazon Alexa and any sort of Internet of Things connected device. I really think this is going to be transformative, and I know we've done a podcast on this topic as well. Now, in particular, one of the key reasons I like the Internet of Things is the incredible growth. Basically, it had 0 devices in about 2008, but expected to have about 50 billion connected devices by 2020, and that information is according to Forbes via Global X funds. It's really where the growth is right now. So one ETF to focus in on for this type of growth in the tech market, and I think it's going to last for another couple years at least, is the Global X Internet of Things ETF, ticker symbol SNSR. Now, this is the only ETF of its kind tracking this market, and it's still in its infancy, but it does have decent assets and tradability, though a modest international component as well. The key thing to note here is there's not a lot of pure plays in the Internet of Things world, so you're going to get companies that have exposure to this trend, but might be doing a number of other businesses as well. The reason I like this ETF play so much is we don't really know who the winners and losers are going to be in the Internet of Things yet, and I think an ETF play kind of goes along with this whole rising tide lifts all boats type thing. In terms of actual holdings, this is very heavy in semiconductors and then also electrical and communication equipment, and I think it's a nice broad play to get exposure to this great trend in the tech space, and I really think it has some long-term staying power. The second area I wanted to look at is China. China is obviously a very high-growing market and an increasingly important one for global investors too. I think most investors have a decent level of China exposure these days, but given that some of the recent trends here and the return of growth to the Chinese market, I think there's probably room for a little bit more exposure for a number of investors out there. Now, one way that I think many people probably haven't thought about yet is with the A-shares market. Now, this is mostly companies that are trading in on domestic Chinese exchanges, and they really haven't been that open to foreign investment until very recently. In fact, many of these shares just got put into MSCI baskets for the first time, so we could see some more demand coming down the pike for this specific type of Chinese share class. Now, one way to focus in on this market is with the Deutsche X-Trackers Harvest CSI 300 China A-Shares Fund, ticker symbol ASHR. Now, this is the most popular of the China A-Shares funds out there and has a great level of trading volume too. The fund is a bit heavy in financials, so definitely keep that in mind, but I think the exposure profile here makes a lot more sense. And that's because Deutsche Bank works with the sub-advisor Harvest Global to get the exposure to the A-shares market, and some of the other companies that have funds here, they either have to use swaps or other derivatives to get their exposure, so it's a little bit more of a pure play with this ASHR fund. I think that's probably part of the reason this is the more popular of the funds in the space, and I think if you really want to play the Chinese market, focusing in on these companies which were, once restricted to domestic investor consumption is probably a great way to go, especially if we continue to see growth out of this market in the future. I also wanted to take a look a bit closer to home back in the US market. Large caps have been running pretty hot as of late, but what about small caps? These have largely been forgotten, but they've been storming back in recent sessions and have been posting pretty good performance numbers in recent weeks. I think this trend could continue for the long term and that we might see more of a shift to small and mid-cap securities. They've been largely underperformers in this bull market, but I think their turn is finally starting to come. Now, one way to play this trend is with the WisdomTree US Small Cap Earnings ETF, ticker symbol EES. Now, there's a ton of ETFs in the small cap market and plenty of great ones. This is by no means the least expensive, but it probably is one of the more unique choices out there. Now, that's because it uses a very interesting methodology which only follows companies that generate positive earnings, and it weights by the earnings produced. So companies in the small cap space that have negative earnings, they're going to be completely excluded from this fund. And if you earn more than your counterpart, you're going to have a higher weighting in this particular ETF. I think this choice is especially promising if we actually do see tax reform over the next couple of years here. And it's probably going to be less impacted by currency issues too, just because it's going to be a little bit more US-centric. Some other key points to note for this ETF are that it's been around for quite a bit of time, and you're going to get a decent amount of exposure in the consumer cyclical, financial, and industrial markets. Either way, though, I think this is a great choice, and I think the small cap space in general is probably one investors want to look at for the next 5 years. All right, let's take another quick look abroad again, and I want to focus in on the European market. We've seen better performances out of stocks from the Eurozone as of late, and the powerhouse of Europe, Germany, is back on track, rising consumer confidence and rising business confidence there. And the euro is also performing quite nicely as of late. I think these are trends that are going to continue into the future, less political risk, and more importantly than any of those factors, Europe is severely underbid relative to the American market. US stocks have really surged over the last 3 to 5 years. Europe is also up, but not nearly as much. And I think there's a big opportunity here for investors who are willing to take a long look at things and focus in on countries in the Eurozone as they get back on track. Now, one ETF in particular I do like in this space, and it's actually been in the ETF investor portfolio, is the iShares MSCI EMU Index, ticker symbol EZU. This fund focuses just on countries that are in the Eurozone, so you don't have to worry about economies like the UK and what may or may not happen with the Brexit situation. Switzerland, those type of nations, Sweden, for example, none of those are going to be in this ETF. It's mostly France, Germany, Spain, Italy, those types of countries. The reason I like this one more than, say, an FEZ is EZU is much more spread out in terms of its assets. FEZ just has about 50 securities, though a lot of them are the same as EZU. But you get a much more spread out profile with EZU, and I do appreciate this one as opposed to some of the currency hedge funds out there. I feel like the dollar strength is kind of topped out in the near term, and when the dollar is going to be weaker, you want to be holding foreign currencies, and I think that's why EZU could be a better choice than some of the currency hedge products out there. That's why I'm looking for this one for the long haul as well. And then the last area I wanted to talk about might be a little more controversial, I guess, than some of the other ones. That's the financial space. So I keep going back and forth on if we're going to see rate hikes here in the near term, but I do think over the next 3 to 5 years, definitely a few more rate hikes, and that's always going to be good for the financial sector. So I think if you do have a longer time frame, financials are going to be good, though I wonder what the situation is going to be like in the near term for this space. Regardless, though, very strong economy. And one other thing to note, there's some pockets are going to be better than others here. Insurance seems a little better. Regional banking also seems to be on the up and up. but the trading revenues we've seen from some companies like Goldman Sachs and, Morgan Stanley and the like, that hasn't been as good. So I'd caution against some of those companies just because the lower volatility environment seems like it's not going to be as great for revenues there. So some of the more traditional players in this space that are more focused on the actual banking activities might be better picks for the next couple of years. Now, one choice in particular I really like here is the SPDR S&P Regional Banking ETF, ticker symbol KRE. This has been an ETF investor favorite for a while as well. Been in and out of this one over the years. It's an equal weight product, so you're not going to get the concentrations that you see in other ETFs out there like an IAT. And just for example, IAT, it has about 26% of its exposure in two stocks, USB and PNC, and you get nowhere near that in KRE. So you're going to get things a bit more volatile, but also a bit more spread out. And I think that's a lot better for investors in the ETF world. And that's why I almost universally prefer KRE to IAT, especially if you have a longer time frame. Now, one other choice that could be interesting in this particular market is QABA. That's more of a community bank ETF. So if you want a sort of a happy medium between the gigantic banks and then the QABA on the other side of the spectrum, I think KRE is a nice happy medium there. And that's why I'm looking for this one to be a strong performer, if not in the near term, then over the next 3 to 5 years. Okay, everyone, those are my picks. Let me know what you think of them by sending me a tweet over at Eric Dutram, especially if you are in agreement with them. Well, hope you enjoyed this Dutram Report and the rest of the series as well. Since this is the final article I'll be doing here at Zacks, make sure to check out the rest of our great shows to get your podcast fix. Hope you have enjoyed listening to me and have gotten something out of this program too. But for now, this is Eric Dutram signing off for Zacks.com.